The real estate industry is eating itself alive. Every month brings another mega merger as firms desperately chase AUM to avoid irrelevance. Case in point, Ron Moelis just sold a minority stake in his affordable housing developer L&M to Sixth Street, which controls a $100 billion war chest. But here's the thing about the wave of consolidation. It's not random. Capital is looking to get direct exposure to all the lucrative niches in the game, niches that require specific expertise, political clout, and boots on the ground. Rather than go and build all that action from the ground up, the mega managers are just going and buying it. Let's break it down, because this might just be the most important trend playing out in CRE right now. Okay, so we gotta talk about moats. Affordable housing isn't just moaty, it's practically a medieval fortress. You can't just show up with capital and say, hey, I want to build affordable housing. You need what the industry calls juice, the kind of political clout at the city and state level that takes decades to build. Ron Moelis, well, he has that juice in spades. L&M owns 15,000 units across the 5 boroughs, and he knows the people you need to know. Anyone recall the legendary exchange he had with then Deputy Mayor Alicia Glenn? She's flying back from Shanghai, texts him and says she's dying for a, quote, hamburger and a bottle of Montrachet. The kind of embedded political clout you can't buy, you can only develop over time. And then there's the technical know-how. To operate at this level, you need to navigate cap stacks with 9 different funding sources, and each of them has its own Byzantine approval process. It's death by complexity, which is kind of the point. And as to why Sixth Street wrote this check, affordable housing development generates fee streams that make traditional real estate development look like a crapshoot. We're talking development fees collected upfront on every project, predictable revenue that doesn't depend on property cash flow or market timing. Steve Ross started his empire off on this model, now he's a billionaire who owns an NFL team and can shape cities to his will. The beauty's in the machine. Once you've got the regulatory relationships and development pipeline humming, you're printing money through fees while someone else takes the construction and lease-up risk. Scale really matters here. L&M's 15,000 unit portfolio generates a fee stream that smaller players can't really touch. With Sixth Street's balance sheet backing them, they can go national, assuming they can replicate that political juice in Chicago, Atlanta, and beyond. Now, this deal's part of a much bigger story. It's the era of AUM gobbling. Barings buys Artemis, Ares buys GLP, Blue Owl buys IPI. Every month brings another acquisition as firms chase the scale necessary to compete at the highest level. Drew McKnight at Fortress said this explicitly. For us to compete with larger firms like Ares, Apollo, and Sixth Street, we need to continue to grow assets. Because if we don't, then we'll be less relevant, he said. Here's what's driving all this. Allocators are done playing single stock picker. They got burned in office, in retail, and obviously Sunbelt multifamily. Now they want the full poo-poo platter, diversified platforms that spread risk across strategies and geographies. They'd rather pick the horse than make individual investment decisions that could tank their careers. Think of the CAIS, the Québécois Pension Fund. Its new head said directly that it's getting away from being an investor-operator and becoming a, quote, pure investor. Translation: bring us partnerships, not projects. The math is brutal but simple. Capital is flowing to the biggest brands with the least career risk. The 6 largest private equity shops have captured an overwhelming share of fundraising over the past decade. Meanwhile, firms that you would recognize are struggling to raise capital. They're either going smaller on their next funds or simply becoming zombies. So there are really only 2 viable strategies left. 1, get massive through M&A, or 2, become such a sharpshooter specialist that the mega funds have to partner with you. The middle is death. For affordable housing specifically, that regulatory complexity we talked about, it's not a bug, it's a feature. It creates natural consolidation around the handful of players who can navigate the system at scale. So while everyone's focused on the L&M Sixth Street headline, the real story is structural. We're watching the birth of a new real estate oligarchy, where owning a collection of platforms with moats really becomes the only game worth playing. The question isn't whether this consolidation continues, it's whether your firm ends up a buyer, a seller, or roadkill. If you enjoyed this video, please tell your fellow CRE junkies about it and like, share, and subscribe. And for more insider juice, check out thepromote.com, the Promote podcast, and our YouTube channel. Thank you so much, and until next time.